We did a show recently with a friend of yours, Adrian Mastracci from Vancouver,
Yep.
and we talked about retirement a lot. When you are speaking to these various groups right across Canada, inevitably that subject is going to factor into your presentation.
Yeah.
What 2010 retirement strategies are you advocating these days?
Well, I think we're at, I've been mentioning we're at a pretty important point in the crisis in my view, because what happened was when I was writing Juggling Dynamite in 2007, it looked like, sorry, in 2006, 2007, the book came out, it looked like we were about to hit a wall on the crisis in credit. In fact, we did in about March 2000, and by 2008, everything was sort of imploding. What happened then was that the governments turned around to rescue the system, which they've done notoriously now, really since 1987, all the way through. Every time there was a major crisis, the governments come in to try and rescue. That's the worst mistake we could have made, right? So I think really we're at the point now, interest rates fell for the last 28 years. We're probably into a secular uptrend in interest rates now.
Likely, yes.
Right?
Yeah.
So people are now having the hardest investment time of their life. Why? Because there's bubbles in all sorts of things. They turn around. Stocks were briefly valued at a reasonable level last March, April. And then now they're back to most expensive range ever in history. So other than the tech wreck, where prices went, really off the charts, we're back in historically very expensive range. That means stocks are likely to be very unrewarding if you're trying to hold this equity tiger by the tail right now today at these prices, okay? That means that's not probably going to be a great strategy for you. Bonds are also probably overpriced right now because there's this big risk aversion where people went to the bond market, and for 28 years rates have been falling. People are desperate for yield nowadays. So you turn around and you go, great, thanks Danielle, real estate's overpriced, bonds are probably getting to overpriced, equities are looking really expensive. What am I supposed to do with my money? And my answer would be right now, build up your savings and take your, yes, meager returns in terms of interest, but I think that in the next couple or 3 years, you're going to find an increasing trend in rates. So you're going to have an opportunity to roll money over at better and better rates for a while, which will go back to rewarding savers. Right? We've been penalizing savers in the last year because people with money have been getting nothing, and that means the reckless risk takers have been able to take money for zero and double down in risk assets and look like geniuses again. These are not sustainable trends.
All right, our special guest this week is Danielle Park. She just moments ago opened the door to the whole matter of real estate and bubbles in the same sentence. We'll pick up on that here on the Money and Wealth Show when we come back.
Good afternoon. My name is Larry Ray. I'm the President and CEO of American Manganese, Inc. I'm here to tell you today that American Manganese could possibly bring in the lowest cost electrolytic manganese metal mine in North America. It'll be the first one in the past few decades. What is manganese? Well, you can't have a steel industry without manganese. If you don't have manganese, you don't have steel. If you don't have steel, the world stops. North America has no manganese. We depend on our neighbors and other countries to import our manganese, and it just doesn't make any sense we don't exploit the resources in our own country. So I'm here to tell you that we are moving ahead with the feasibility study, we're moving ahead with the environmental studies, and we're moving ahead with a massive drill program in order to build the American Manganese, Inc. into the first primary electrolytic manganese producer in the United States. Please visit our website at americanmanganeseinc.com or call us at 604-531-9639. Thank you.
Welcome back to the Money and Wealth Show. I'm Sterling Fox, in conversation this week with Danielle Park from Ontario, author of Juggling Dynamite. And her website, by the way, is jugglingdynamite.com, full of terrific blogs and great links to provocative thinkers. Danielle, you were talking about real estate just a few moments ago and how pretty much across the spectrum, everything appears to be super valuated. I think real estate is perhaps the best example of hyper-inflated values. You take a look at the asking price of a house in Toronto or Victoria or Vancouver versus what you know that the house is probably really worth, and the difference between the two is astronomical. So what are you telling clients who are coming to you as a financial advisor saying, I got a little bit of dough, I'm all set to buy. Turn me loose.
Well, you know, we have to look at reasonable metrics again. So we look at valuation levels and things like the current average price of real estate versus the current average family income in Canada, which right now is north of 7 times the average income.
Right.
At the peak of the US bubble, it was 5 times. In places like Australia and New Zealand, it's also about 7 or 8 times. These are historic measurements that tell us that real estate prices are not going to be sustainable at these levels. The only reason that Canadians have been able to go on a bit of a spending splurge in the last year has been that the efforts to revamp the housing market goosed up prices again. Because if you remember, Sterling, a year ago, Vancouver prices had come off something like 20%. And in the last year, they quickly rebounded again.
Sure, sure.
So that's sort of a shot over the bow, I think, because Canada can't be immune from the trends that have been sweeping the world, okay? And what happens in every place is when real estate gets overbuilt and overpriced, and by the way, we haven't had much in the way of real wage gains in this country for the last 25 years.
I'll testify to that.
Right? Honestly, the way that we've been
I'm not kidding either.
The way we've been able to live the life of all the magazines, etc., is by leveraging housing. Because interest rates fell for 28 years. I have charts in my book showing that interest rates, you know, on mortgage rates and on deposits fell all the way from 1980, all the way. And just when you thought it couldn't get any lower, it got lower still. There's a mortgage sign I drive by every day now that says mortgage rates 1.75. I took a picture of it because I said, you know, I probably won't see this again in my lifetime.
Probably not.
Right?
Yeah.
Which is actually a good thing because it cannot be right that mortgage funds are 1.75%. Now that's a floating rate mortgage, and people have to understand the likelihood of this emergency level of interest rates continuing is not great going forward. So people have got now too much house, they paid too much for it, and the only way they can pay for it and all the bells and whistles is through financing at 75-year lows in interest rates.
Right.
So I think this presents a problem for Canada going forward.